now have a panel on contested M&A. My name's Josh Kosman. I'm a reporter at the New York Post, and I cover M&A as well as other topics. So maybe we'll start by introducing the guests, and maybe as I introduce each guest, I saw in another panel we were talking that there'd be a lot of increased M&A, maybe even next month. So maybe I'll ask each of you as you introduce yourselves to tell us if you think there is going to be a lot of increased activity, not just next year, but even next month as 13Ds become public. Ira Gorski, if we can start with you.
Great, thank you. I'm Ira Gorski. I work at Edelman Smithfield, a financial communications firm. And I do think there should be a pickup in M&A. There's a valuation disconnect where companies may start moving towards stock to make the consideration more equivalent. So for example, if their stock's depressed and the target's depressed, then they could offer more stock. However, that causes a different problem, which we've seen in contested M&A, which is if the acquirer offers stock that's more than 20% of their float, then it requires a vote on the acquirer side, which often gets challenged.
Thank you. Jonathan Feldman.
Hi there. Are we just going to be on page 6 of...
Matters what you say.
That would be a first for me. My name's John Feldman. I'm a partner at Goodman's in Toronto. I practice M&A and shareholder activism, and this panel kind of covers both. I think M&A has been challenging, particularly when it comes to the sort of all-cash deals. I think there is a big disconnect on value, and so I think where we're seeing, at least in the public markets, more M&A is on the sort of stock-for-stock types of deals. Whether there's going to be more in the next month or so, we always try to be optimistic because otherwise we don't eat, but I guess we shall see.
Sounds good. Bruce Goldfarb.
Thanks, Josh. And if you're in page 6, it's going to be at the cocktail hour, not for what you say here.
Fair enough.
As president of Okapi Partners, which is a proxy solicitation firm, and we work for investors as well as companies, I believe we're going to see a real pickup in M&A going forward based on discussions that I'm having with different parties. In addition, we will continue to see another party indicate they don't like a situation. That has been a trend for more than the last 15 years where one party believes there's value to be had and they look to buy a company. The board is in favor of that transaction. There's going to be a third party who says there's really some more value to be had, and especially even with the higher interest rates, the private equity firms have some money to spend, and they may not just be spending it trading within their portfolios. They may come into the public market.
That's interesting. What are some new strategies that you guys think we might see going forward, especially as we're approaching activist season? Maybe Ira, you could lead off.
In terms of new strategies, I think that companies need to do a better job explaining the strategic rationale and have a lot more details behind it. So one of the mergers that we did that was hotly contested was IAA was acquired by RBA, which is Ritchie Brothers. This was a wild free-for-all. It was a total of 10 activists got involved. 2 of them had switched sides. There was also an activist on the target side that didn't think the valuation was enough. It also involved Starboard providing some preferred financing to get the deal over so there could be some change in consideration. So in terms of rationales, one of the things that I think companies could do a lot better is that they start drilling down on the model level. So when companies talk about their approaches, they talk high-level cost synergies. They may talk about revenue synergies, but what I think they really need to do is to provide enough detail for the investment community to update their models so they could actually do the calculations themselves. And then there's the perception of management and the strategy, which affects the weighted probability of how the investment community is going to weight those potential outcomes. And that's where you get involved with the communication strategy that helps bolster their credibility.
Jonathan, what are you seeing in Canada? I know that's a lot of your expertise.
Yep. Well, first of all, we were involved in Ritchie Brothers as well, and that was an absolute free-for-all. We talked a lot about it last year, so I will not talk about it that much this year. But what I will say is this. 10 years ago when we were doing deals, we worked with our U.S. friends, cross-border M&A. The boards in Canada were always told, doesn't happen that much, but you should assume that if it's a cross-border deal, expect to hear from activists. And we said, oh, that never happens here. Fast forward to last year, and pretty much every single major deal that got announced had an activist jump into the mix. And obviously, Ritchie Brothers is a well-known example. Another example was one called Magnet Forensics, where Thoma Brava came in and got themselves a pretty good deal. And as a result of that, there were some activists that were fighting really hard to kill the deal. They ultimately failed there, but then they went and exercised their appraisal rights. And so I think that where there seems to be a view on the street that there's a disconnect between what the buyer is paying, and in large part that's often a case because you have a board that's in a situation where they're looking down the road at a financing or a lack of financing, and they're saying, how are we going to get through the next 12 months, next 18 months, next 24 months, when our cost of capital is going to be exponentially higher than it was when we first got involved here. The equity markets have been effectively dead since the summer of 2022. Debt financing is really expensive. And so boards are sometimes saying our only alternative now is to sell. And smart buyers are saying, well, then we're going to do this knowing this, and we're going to pay what we believe is a pretty good deal for us. And smart activists are going, no, like money is being left on the table, and we want to see it. And there was another deal that we were involved in called Absolute Software, and I'll tell this story quickly, and then I'll stop talking. Absolute Software, a software business, they ran a bit of a process, and when it all came out, the original bid was for $13. The buyer ended up paying $11, and what happened was the company did two things. Number one, they said, which is typical, there was a dissent condition, so that if more than 10% of the shareholders dissented, the buyer could walk away. Not atypical. In addition to that, what they did is they changed the terms of the debt that was originally due in 2027, but they changed the terms of the deal in the context of this transaction to say that if the deal doesn't happen, the debt gets accelerated. And so suddenly a 10% shareholder that might otherwise dissent, exercise appraisal rights, which could kill the deal, didn't have that right. If the deal didn't happen, the stock was going to be in free fall. And so shareholders had no choice but to vote in favor of the deal. Very clever maneuver on the part of the company, but this is now in court, and we'll see where it ends up going. The board is being sued personally, the company's being sued, and so it was a creative way to get the deal done. What ends up happening, I guess we'll see.
That's really interesting. Bruce, are strategies changing because Target's companies, their options are more limited now because of the financing markets?
Well, the strategies are changing, Josh. It's partly financing. It's partly recognizing the issues that we're discussing about having a more vocal and active shareholder base. So, for example, there are venues through which an investor can say, I don't like a deal, and communicate with other investors either openly, filing proxy materials, going through and using ISS or Glass Lewis to challenge a deal. And so we've been experiencing for a few more tender offers lately as ways to go directly to shareholders without as much hand-wringing, as much of a process to let investors have the time to foment activity among investors. We've been experiencing that the premia could be higher, knowing that there is going to be this kind of criticism for transactions, whether or not truly justified. I mean, sometimes part of the reality is there's valuation considerations, and sometimes it's just spite and jealousy. And those are great motivating factors to make a company and the buying party really justify the transaction that it's going to be in the best interest of all shareholders.
Maybe any of you, give me a good please give me a good activist success story to follow. So give me an example of a situation where you think the activist did well, you know, and it wasn't so easy walking in.
You guys
It doesn't have to
represent
be you,
more on
Ira,
the-
but we're all
No,
looking
no,
at
you
you.
guys represent more on the activist side, so I'll let you guys go first.
Okay, I can
Sure,
give an
go ahead.
example. So, you know, in Canada, I think to some of you, you've heard this spiel before, but in Canada, we represent both activists and boards. It's not religion in Canada, it's whoever we're working for at the time. So, an example of one activist that we've done some work for is Saba Capital. They focus very much on the closed-end income fund trading, and they find there's often what they look for are companies that trade at a significant discount to NAV. And it's very difficult for unit holders of these funds to get out because these stocks don't really trade. And so they agitate. They agitate for redemptions. They agitate for sales. And we had one incident, we had one deal that started about 2 years ago. And the idea was that what Saba wanted to do was requisition a special meeting, something you can do in Canada, for the purpose of effectively changing the manager and redeeming the fund at NAV to existing unit holders, effectively selling and winding down the company. And this was a really talking about the ESG, the G part that we talked about before was horrific. Normally in Canada, to requisition a special meeting, you need 5% of the shares. In this particular instance, you needed 20%. However, if you had 20% of the shares, you were deemed to be an interested party, which meant you couldn't vote on your own called meeting. So it was a pretty crazy situation. So this went on. First of all, it took forever to accumulate the 20% because the stock doesn't trade, but eventually they got there. And then they called the meeting, and there was all the shenanigans you'd expect to see in a typical proxy fight. But at the end of the day, and this is something to what you were saying, Keith, that this particular market cap wasn't high enough to justify both sides going into battle. And so ultimately what happened was the companies came to a settlement, all very public, that they're effectively going to redeem out 70% of the shareholders at NAV. There's going to be an issuer bid, and people that want to get out are going to get out. And this was, obviously it's not typical M&A, but it's effectively the same thing because they're effectively selling the business. And this was a 2-year battle that Saba they were steely in their resolve to make this happen, notwithstanding all the roadblocks. So that was a big win for them.
Yeah, that doesn't sound easy at all. That's an interesting story.
I'll give you a different
Go ahead.
perspective, Josh. And here we have activists who have effectively become private equity buyers. And so that's when we're talking about M&A, a lot of activism is put your mouth where your money is, and then you flip it around in private equity and you're really putting your money where your mouth is. And that's what we see with Elliott very frequently. Athena Health, perfect example, where they bought the company with another private equity firm. They've turned it around. They've resold it at a premium. So, you know, one could argue that a lot of the value remained with the investors and that or with the private equity side, and that's part of the challenge here. But on the activist side, it is about identifying value. Very frequently that's in the proxy fight side as opposed to the M&A side. And that's what really ends up making this process so interesting, is that there's valuation, there's valuation, there's valuation. If it works right, activism creates value moments that can create other value moments, that the one stayed place, which is the challenge on the M&A side, is this the value that is the, you know, sort of the ultimate value that you're going to extract.
This really brings up a good point that Elliott can buy its own companies in its fights, but not many firms can. And I would just imagine that for the same reasons we've been hearing all day, that there's not a ton of buyers out there. So even if you force a company up for sale, even if it's a private equity firm, you got to finance it. That there would have to, I would imagine, you guys would know better than I, there's less buyers than there used to be.
The bankers are unhappy. The lawyers are somewhat indifferent because there's been a lot of work to get to deals, and many of them just haven't happened. So, I mean, it's just, you know, there's been a lot of processes that have just gone nowhere. because for all the reasons I said before, there's a desire to sell, but there's just not the same willingness to buy at the value that, you know, that a bank can say is, you know, can give a fairness opinion and say is actually fair value. And if you don't sell at that level, if you get you know, it's pretty challenging to get that through, you know, a shareholder vote.
Yeah, that's actually a good point, that because since I represent companies, I'm not on the activist side, but I see the activist efforts behind the scenes. And where I can say this because I'm not going to disclose the company, where I think the activist actually did a very good job is the activist sent a letter to the board privately behind the scenes and essentially said, be very thoughtful on your capital allocation. If you're planning on mergers in this particularly hot sector, which we think is overpriced, we're going to come after you. And it chilled a potential deal, and I think it actually was beneficial for shareholders.
I would just say one other
Sure,
thing,
go ahead.
which is, and this is something that I think the letter went out yesterday, and this was GFL, right? Where there is an activist, the son of Ron Wyden, Adam Wyden his name is, I don't know him, but I just read the letter. And in the last round of IPOs, more than we'd seen in many sort of cycles, there were a number of, call it dual class share structures that were put out, where you had subordinate voting shares and high voting shares. And so companies in the last round of IPOs, knowing that there was a round of activism that was coming, created for themselves these structures that effectively makes it virtually impossible to at least affect board change. You can influence, you can use moral suasion, you can vote with your feet. But your ability to affect change at these companies with your votes are somewhat limited. And so some of these companies that are now in a little bit of trouble find themselves in a position where it's like, well, if you don't like it, just sell. Obviously, that's not great for long-term shareholder returns, but insofar as a structural defense is concerned, it's pretty bulletproof.
What are some lessons of activist campaigns that have failed? So I know we spoke before about Misellum Advisors, not to pick on them, but had a horrible campaign against Kohl's where they're stuck with the Kohl's stake and the Kohl's is trading at, you know, very low numbers. Either that or another example. What's one we could learn from where activists plan poorly?
I think, to steal from you, the Kohl's is a perfect example, because if you start getting too greedy, demanding too much value, it takes two parties. And if the other party doesn't believe it's worth it or can't get the financing or the market changes, then you're not going to wind up with a transaction. You know, dating myself because I am old, there was a transaction a long time ago, Lear, which was going to be acquired. And there was opposition. It was actually Carl Icahn who was going to acquire it. And there was so much opposition saying they're stealing the company, and Lear filed for bankruptcy.
Yeah. I mean, we have a lot of what we call vote no campaigns, where there's a deal that's announced, and I forget the name of it, even though I worked on it. I guess I'm getting old too. It was last summer, and there was a big letter writing campaign in an effort to kill the deal for all the reasons you'd expect them to do. And it got to the point where the board actually delayed the meeting because they were concerned they were going to lose. But then ultimately, the board made a few phone calls, kind of similar to Ritchie Brothers, and they prevailed. But it was, it happens. I mean, yes, it's a fail, but it doesn't cost much to write letters and to put your views out there and to speak to other shareholders. I mean, that is what a good market does. It allows market participants to communicate with each other, to express views, and ultimately, you know, it is a democracy, and people vote yes or no, which I think is what you want to see happen. But, you know, is it a fail? Yes, but did it make people think? Did it make them reassess the deal? Yes, so yeah, there's fails.
So building on what Jonathan points out about corporate democracy, it's a rare situation where you have an overwhelming vote one way or another, depending on how you define overwhelming. I mean, in this world, we've had people ending up getting onto boards and not even getting the majority of the shares that were voted. And so what's an actual fail sometimes? It's hard to determine short term. It's a longer-term process. And when an activist, for example, is opposed to a merger, sometimes they're really just opposed to a merger at that price. And it may be that they're going to end up with a transaction that occurs at a better price. So did they fail in their campaign? I don't think so. Was their campaign wildly successful? Again, it depends on what their objectives are. And going into so many of the campaigns where we're representing one party or another, we need to understand what those objectives ultimately are.
And the reality is, I mean, M&A is one thing, but in proxy fights, no activist or no board likes to take a loss. So as a result of that, which many people here know, the vast majority of these do get settled.
And we even spend time with clients talking about whether a campaign is actually achievable. And so there are campaigns where we know that we have a client going into the campaign that they are not going to win the vote, but they may well have achieved a successful outcome by running the campaign.
Well, it's interesting that you say that because, and there's a whole spectrum, right? You can write letters, you can run a full campaign, you can end up in court, you can be in front of regulators. But if one of the things you're doing, as call it an activist, is trying to establish a name for yourself and putting your ideas out there, to your point, when you even know you're going to lose, but you're putting it out there almost as an advertisement to say, we got your back, retail. You know, we're thinking of you. We're thinking of ways to do things better. That is sometimes a strategy. Sometimes you do it because you have other objectives and you want to agitate, and it results to opening doors for conversations that might not otherwise be available. So sometimes the fight and the activism itself is just a tool towards achieving a different, objective.
That perfect example is, especially when you have an activist with a de minimis stake going after a marquee name. So they know that there's going to be news covered on that marquee name, and they just put it out there. This is essentially an advertising campaign where they get the earned media. Everyone now has to at least comment on them. People will call them. And they really don't accomplish anything other than their own potential capital raise.
I'm wondering what you guys think of something like Elliott and Hess. Like, Elliott went after them for years, 2 different campaigns. I think they made decent money, but after they exited in 2020, 2 years later, they just sold to Chevron, if it clears regulators, for $171 a share, a huge jump. So what lessons, if any, do you take out of that? And it makes me think, like, some of Carl Icahn's campaigns, if we go back 20 years or so, his campaigns against Nabisco. It was 3, 4 attempts. Was Elliott right to leave in 2020 with its victory? Should it have held on? What can we take from it?
What you can take is no one really has great insight into the longer term market. And it's the same thing where activists get themselves in trouble when they push for a sale, but there are no buyers. Or there were buyers at one point in time and the macro environment changes. If they had such great insight into the much, much longer term, they could have all sorts of other type of positioning to make multiples, but they would just buy call options on the market. So you're never going to be 100% correct. Either you're wrong fundamentally and you lose money, or you're right and you weren't as big as you should have been in the name. So it's just really, really difficult to make long-term picks that are going to stick.
But I'll look at the Elliott campaign at Hess as that long-term battle, that when Elliott looked at Hess in 2013, it was an entirely different company. It was a company that was in some ways focused on what interested John Hess, as opposed to what necessarily was of value to the long-term shareholders. And Hess had some great assets. The campaign and putting a lot of new board members on the Hess board helped unlock that value, helped focus Hess, helped strategize Hess, so that there was some really great assets that somebody else wanted to buy.
I'm going to just violently agree with you to say that if it wasn't for Elliott, I don't think this deal would have happened. And it's nice that, if we all had a time machine, we'd all go back to 1994 and buy, Amazon stock, and none of us would be working today. But Look, if it wasn't for what Elliott did, my view is this deal would never have happened.
Well, that's right. And so, look, Elliott made a decent return, and other investors who held longer will end up making an even better return. So for the activist haters, there's something to think about.
Yeah, I mean, I guess I wonder if Peltz is going after Disney again. Is there a point where you, as an activist, should, okay, I made some money, time to leave? Or if you really believe in your thesis, should you stubbornly hang in, campaign after campaign after campaign, thinking that ultimately you're going to be proven right, as Elliott was with Hess?
Well, and I don't know that any activist is in this business to just be proven right. They're in this business to generate returns for their clients. And thick-skinned activists will take the criticism and show their investors the returns that they're right.
But it's going to be a risk reward. So if you can continue to agitate, as long as you don't feel there's much downside in your stock, and the cost, which is going to be de minimis for a large activist, you might as well stay in it if you don't think the downside's going to be too onerous.
Just in closing, what sectors do you guys see the most activist activity coming up? Again, just in a month, in December, we'll see a lot of public filings.
Not so much I don't know from the activist side, only if they're reluctant to sell. I think that the industrial side, in particular, companies that help support the grid, that are either around it, providing materials, providing services. The electrical grid is really deteriorating, and there's a lot of build out for renewables in terms of generation and transmission. So I think there's going to be a lot of activity there.
We're seeing quite a bit in real estate, but the REIT sector, I just don't know what the thesis is on a go-forward basis. And one thing there's agitation, but the question is, how do you get there? And it's been highly problematic because I think, as on the earlier panels, nobody knows where that's going either. And but we are seeing letters, boards are getting letters, and they're kind of asking, okay, so what do you want us to do about it? Give us some ideas, give us some potential buyers, let us know what you think. So I'm hopeful there will be some M&A in that space, but it's going to be choppy.
Yeah, the M&A side, there's all sorts of sectors where people have those ideas. Where the execution comes, hard to say. I mean, the activism certainly will come in all of these sectors, as well as potentially the COVID economy winners who are a little more challenged.
Yeah.
Great. I think we need to wrap up for lunch.
All right.
And,
Okay.
thank you very much.
Page